Patterns are not something you memorizing. They are reactions to the market psychology. If you skip this part, everything you learn here will be incomplete. Today we are breaking down double tops and double bottoms. Not the textbook version you have seen 1,000 times, but how is the market actually behaves. What's up traders? Welcome to Immortal Trade channel. Market repeats behavior. Not perfectly, but often enough to trade. Roughly 60 to 70% of the time. When price fails at an important level, the market will test it again. That second test is where double tops and double bottoms are formed. Let's be clear. Double tops and double bottoms are reversal patterns, not trend continuation setups. Yes, there are rare exceptions during corrections, but their core nature is still reactive. Double tops carry a bearish bias. Double bottoms carry a bullish bias. A real double tops has two highs that are very close to each other. If the second high is clearly higher or much lower, it's not a valid pattern. Time separation also matters. Two fast spikes with a tiny pullback in between count as one high, not a pattern. A valid structure needs a space, clarity, and intention. Structurally, a double top has two visible highs, a clear valley between them and a resistance zone being tested twice. In an ideal scenario, the second high forms with lower volume, showing that buyers are losing strength. There are multiple ways to trade this pattern. An aggressive entry is taken at the second high after a rejection candle, with the stop loss placed above the resistance. This is risky because price can still break higher before reversing. The higher probability approach is to wait for the valley between the two highs to break and for price to close below it. Once that happens, the pattern is activated. Entry comes after the break and the stop loss goes above the highs. For a safer, more professional entry, wait for the break, then a pullback into the broken level followed by a rejection. This reduces risk and improves consistency, even though it gives fewer trades. Targets are measured from the valley. Here's what most traders miss. Large players often don't trade the pattern itself. They wait until price reaches a risk-reward of 1-to-1 and only then confirm that market structure has shifted. A double bottom follows the exact same logic, just inverted two lows. Weaker selling pressure on the second low, a break above the middle high, and then continuation. Many traders only enter after price moves 4 to 5% from the break. It's later, but it's also safer, and price often still runs another 10 to 15%. Patterns are not about targets. They are tools for trading market phases, trend shifts, and crowd behavior. If you only trade patterns for targets, you will always be late. Most traders fail with double bottoms because they treated the first bounce as confirmation. It's not. The first reaction only shows that buyers are present, not that they are in control. Control is proven only when price breaks structures and holds above it. Volume behavior is critical here. On a healthy double bottom, selling volume dries up on the second low. That's the market telling you sellers are exhausted. If volume expands aggressively on the second low, the pattern is already invalid, even if price later breaks higher. The breakout itself is not the signal. The acceptance above the neckline is. Strong patterns don't explode instantly. They pause, retest, and build new demands above the level. That pause is where professionals enter, not the first candle. This is why waiting feels uncomfortable. Price already moved, chart looks late, and emotions kick in. But trading is not about being early, it's about being aligned with confirmed behavior. When price reaches a 1-to-1 risk to reward, something important happens. Early buyers take profits, late sellers get trapped, and new participants enter. This is why the market often pauses or ranges at these levels. It's not random, it's redistribution. If the environment supports continuation, the pattern expands naturally into higher targets. If it doesn't, price shifts into consolidation or reverses. Either outcome gives information, and information is what traders are paid for. Patterns don't predict, they filter. They don't promise profit, they reduce uncertainty. And the trader who understands that never chases moves, the markets comes to them. Sometimes double tops and bottoms evolve into triple tops or triple bottoms. The logic doesn't change, each attempt usually shows weaker volume, and once price reaches a 1-to-1 risk to reward, we assume the market environment has changed. One final insight, at risk to reward levels 1 to 2 and 3, the market naturally creates new supply and demand zones. This is market mechanics, not coincidence. If this helped you, save this video, share it, and drop your questions in the comments. Trade smart, not emotional. Goodbye.